to this edition of Hardman Talks. My name's Keith Hiscock and I'm the Chief Executive of Hardman Co. We're delighted today to be joined by Serge Demay, who's the Head of CLO Investments at AXA Investment Management and the Manager of Volta Finance. He'll be giving a live presentation followed by a Q&A session on how Volta is seizing the opportunities presented in these rather volatile times. Just as a reminder, Volta invests in a diversified portfolio of structured finance assets, predominantly CLOs, and as such is a vehicle for qualified investors. Please pay particular attention to the disclaimers on the presentation on our reports. Without further ado, let's go across to Serge.
So yes, thank you everybody for joining this call. I'm going to share my screen. So first thing to say, as Keith mentioned, is that clearly we are entering into a period with more uncertainty and more volatility. But as always, this kind of period is on both sides. It's potentially more risk, but it's also many opportunities which are coming to us. So a few things to remind about Volta is that Volta, as Keith mentioned, is investing in leverage instruments, structured finance product, most of it being CLOs. For the one which are following Volta for several years, you probably noticed that years after years, Volta is more and more a CLO player. We have nowadays 92, close to 93% of our assets which are either CLO debt or CLO equity. And the idea is to continue transforming Volta so that Volta at some point will be a pure CLO fund, which we are convinced is easier to understand for all of you and easier to market as well for new clients. So the first thing to mention relative to the current situation is that last year we were in an environment with a relatively low spread, and on Volta we definitely took the opportunity of those tight spread during almost 1 year in 2021 to significantly reduce the cost of the leverage we are benefiting on CLO equity, and it's going to be very important to generate performances in the coming years. The second thing to mention is the fact that Volta is investing in loans through CLOs, and loans and CLO are floating rate instruments. So Volta is absolutely not suffering from the increasing in rates. We are totally immune from higher rates. It's even slightly positive in the way that as our assets are paying LIBOR or SOFR or EURIBOR plus margin, if such floating rates are higher, at some point we will have higher cash flows. The last thing to mention is that Volta, because we don't want to have too much margin calls on currency exposure, have some remaining currency exposure. So basically we are long dollar, but for 30% of our net asset value. And this long dollar has always been a good edge for this kind of volatility. And again, this time it was very positive for Volta to have this modest, let's say 30% exposure to the dollar. One good thing to mention, we're still waiting for the end of May performance, but at the end of April, the performance of Volta year to date in 2022 was still positive. The positive performance is, to me, a sign that things are much more balanced than what we may think. So there is obviously a bit more risk nowadays and volatility, but there is also opportunity. And this good performance, or at least positive performance, is demonstrating that this is also the market view. So if I look at the situation of Volta today, we are still generating very strong cash flow. It is the case for several years now. The cash flow we are receiving, which are basically on a quarterly basis, but annually speaking, are in the area of 15 to 17% of the NAV, which is very high. We have for Volta a dividend target, which is 8% to the NAV. So taking into account the discount of the share price to the NAV, it's something like 9.5% to the share price. We have always been able to pay this dividend, and the dividend today is very, very well covered by the level of cash flow we are receiving. And if you see the fact that there is an extra covering of the dividend and there is some assets which are maturing as well, give us a lot of flexibility to take opportunities either in the primary market or in the secondary market when those opportunities are coming. So if I move to the next slide, in terms of the transformation of Volta for the most recent years, you can see that very clearly. We increased the weight of CLO equity in green and the CLO debt in pink or something like that. So that nowadays CLO debt and equity are 92-93% of the NAV. And our wish is, and our willingness is to continue increasing CLO debt and CLO equity. The reason why we decided 3 years ago to increase CLO equity is that we had more and more evidence in the market that CLO equity were able to adapt to period of stress, typically through the COVID. CLO equity was also able to benefit when spreads were lower through many refinancing of CLO debt. So it is typically what we did last year. And so we are convinced that CLO equity is a very good play, even in period of volatility. So showing directly the result in terms of cash flow, and you can see here the cash flow for the last 5 years. Obviously, at the period of the COVID, there was a bit of volatility in terms of cash flow, but you can see that globally, the cash flow are increasing for the last 5 years. And when we look at the cash flow for this year and next year, for the moment, we have absolutely no reason to think that we are going to suffer some diversion of cash flow at the equity level. So we expect those cash flows to continue slightly increasing, or at least being flat. So still providing a very strong level of cash flow to Volta, again, in the area of 15 to 17% of the NAV, which is very important. A few words about the current situation, and probably something that I dare to insist a bit on is that most of the time people consider that inflation is a kind of threat for investment. Probably it is for equity market, because if inflation is coming with higher rates, at some point you are going to revise downward the PE ratio. But for credit, and I will talk a bit about the 70s, but for credit, inflation is basically our friend, because when there is inflation, and it has been the case last year typically, there is the mechanism of debt erosion, which is very strong. And typically, just to give one figure, if you have a 6% inflation for 7 years, the debt you have to repay after 7 years, which is the average maturity of loans, this debt has been declined by 1/3. So repaying debt, refinancing debt when there is inflation is generally facilitated. And typically in between 1971 and 1982, so 11 years during which the inflation was very high, the average default rate on US high yield and US loans was below 1.5% for those 11 years. And it is the longest period of low default rate that we record typically in the US high yield market. So inflation is very powerful in order to erode debt and facilitating refinancing and avoiding default. Obviously, this time, we have an inflation which is a bit different with the Ukrainian crisis, because it's more a commodity shock than a global inflation. And yes, through this kind of shock, there will be some winners, the ones which are producing energy, and there will be probably more losers, the ones which are very dependent on energy. So yes, we do expect to see some impact in the loan market. We do expect to see at some point default rate to increase. We expect as well that there is an economic slowdown which is coming, but the very important thing, and I will come to that on the next slide, is that we are starting from a point which is very favorable to corporate. So even though we expect default rate to increase modestly this year and probably a bit more next year, you have to remind that the average default rate for loans is slightly below 3%. And so if clearly this year we are going to be far lower than that, probably next year we could be in the area of 2 to 3% default. So we are still in an area in terms of default which is very manageable in terms of risk for CLOs. And obviously the counterparty of higher defaults is loans trading at discount, is higher spread on new loans. So we will see, and we already started to see that, we are seeing the weightage of spread inside the CLOs. So the pool of loans which are inside the CLO, we are seeing those weighted average spread already starting to increase, so generating stronger cash flow to Volta CLO equity position. So again, I insist a bit on the situation of inflation. If we look at what happened during the COVID, so the last 2 years between Q4 19 and Q4 21, sorry, you can see that basically, if we look at the US economy, everything's move 10 or 11 to 14% higher, except two things: government debt 33% higher, and corporate profits, which are basically 31% higher. So that's a very good illustration that you can live in a world with a bit more inflation, and it is very favorable to corporates. And the second thing is that we are starting from a very, very good point of view for the people which are looking at macro figures. You can look at the ratio between corporate profits in the US and GDP. In Q4 2021, this ratio was 8% of GDP as corporate profit, which is the higher for the last 50 years. So we are starting from a very, very high level. And so, yes, we are going to come into a period of economic slowdown with more volatility. But even though profits or EBITDA are flat or declining by 10-15%, they are still very, very above average figures that we've seen for the last 1 or 2 decades. So we start from a very good point, and that's probably the reason why, and it is clear the reason why, sorry, why we typically, here I quote the last Fitch rating research. They analyze the situation of corporate credit and ratings for loans and high yield, and basically, and with a very negative scenario, so going into a recession in the US and in Europe, and at the end, they are very comfortable with the situation of corporate, and they found only few industries which are at risk of being downgraded with this kind of scenario. So you see that you can read the research from rating agencies, but rating agencies, which are generally very conservative, are recognizing that we are starting from a very, very good point, and that because of that, the situation should be relatively stable. So it doesn't mean that I totally exclude that we are going to see more downgrades and more default. I definitely think that we are going to see more downgrades than upgrades in the coming 18 months, but default rates are going to increase. But in any case, we are expecting a wave of downgrades or a wave of default, like the one we had with the COVID. It's going to be something much more smooth, and so something which is much more manageable for the type of position we have in Volta. Coming back to one of the positive things of Volta is the fact, and here I just give you some examples of refinancing and reset of CLO tranches. So refinancing is that when you refinance only few debt tranches of a CLO, a reset, you refinance all the debt tranches and you change the CLO documentation. So typically during the last second half of 2021, here there is the example, we lowered the cost of leverage by 26.5 basis points for our CLO equity position, meaning that as a CLO equity position is basically a 10-time leverage on a portfolio of loans, having a cost of leverage 26 basis points lower means that the cash flow are expected to be 2.6% higher. So that's very powerful. And the good thing is that this type of crisis, the crisis we are facing nowadays, is coming after a year during which we were able to refinance or reset most of the position we have in Volta. And so we are going to benefit in the coming years from those refi and those resets that happened last year. Another example of things that could happen, because those refi and reset are for the existing position, I would like to remind to all of you that even sourcing in the primary market a CLO equity when the market is in stress could be very, very profitable. Here I quote the one position we sourced in Volta in 2016. Sorry. And The market situation, even though the context was different, but the market situation was relatively the same. Loans were trading in the 94-96% context as it is nowadays. And so we sourced a position in March 2016, and the loans inside this CLO was purchased at 96% of par. And so because we were able to reset this position 2 years after, and probably some CLO which are priced today will be refi or reset in 1 year and a half or 2 years time. At the point in time of the pricing, we was able to extract the extra subordination, because the loans that were purchased at 96 was basically valued 99, and 20-25% of the loan was prepaid at par. So there was extra subordination in the CLO, and all this extra subordination was directly paid to the equity. So that's typically an example of a deal sourced in a period of relatively high stress, and that performed very, very well, because at some point in time we were able to extract the performance of the loans that has been purchased at discount. So participating in new CLO in the primary market when the loans are purchased with discount, obviously the pull to par or the prepayment of part of the loans during the life of the CLO will strongly benefit to the equity. So that's another example of positive things that may come with the volatility which is coming and in which we are living for already a few months. So just to summarize where we are, and just on the existing position, we do not expect any diversion of cash flow from a CLO Volta equity position. So we definitely expect the current cash flow to continue to increase, or at least to stay at the current level. When I look at the portfolio for the last 6 months, we are a bit more prudent tactically. So we added a bit more CLO debt. So if tomorrow there is opportunity to purchase CLO equity in the secondary market at discount, we will be able to rotate part of the CLO debt into CLO equity. On top of that, we still have 8.5% of the portfolio, which is non-CLO position, that has been sourced many years ago. And some of those positions are going to amortize this year, and some others next year. So we will have some cash to reinvest in opportunity, again, either in the primary or in the secondary market. The last thing to mention is that with cash flow in the area of, let's say, 16 or 15 to 17%, we definitely have cash to seize opportunity in the secondary market and primary market. So just to conclude, Volta has been able to maintain its dividend for the last 3 years, going through the COVID and then now going into the Ukrainian situation. We definitely think that there is no reason we won't be able to maintain the dividend. Our willingness is to continue transforming Volta into a pure CLO fund, because we think it's easier to understand doing only CLO debt and CLO equity and no more recap or ABS and so on. So a simplification of the message. And obviously our mid to long-term target is to grow the NAV and to increase the dividend, but still maintaining the dividend at 8% ratio to the NAV. Thank you very much. And I think if Mark, we can now open the Q&A session.
Brilliant, thank you, Serge. A very good exposition, I think, in terms of the opportunities which the fund has. First one is to say, and this is really to give some colour on one of your very first points. Please could you comment on how each 1% market interest rate rise will impact on the fund's performance, and what are the most relevant rates to the fund's performance?
Definitely, the Volta is investing in CLO debt and equity, and so CLO debt we are paying LIBOR or EURIBOR or SOFR nowadays in the US plus a margin. So every point in time the LIBOR or SOFR or EURIBOR is increasing, it's increasing our coupon. For equity position, there is a bit of tricky things in the way that most of the loans benefit from LIBOR floor or EURIBOR floor. And so part of the cash flow we are receiving at equity are due to those EURIBOR floor or LIBOR floor which are in the money. So LIBOR floor are not anymore in the money because LIBOR is already close to 1% or above 1%. In the US, there is still some EURIBOR floor. So the first hike in interest rate are decreasing the cash flow we receive to the equity. So it already happened on the US dollar position. If tomorrow rates in Europe are above, let's say, 0.5%, it will have this kind of negative impact on our equity position. But after that, after 0.5%, basically, we benefit from the increase in interest rate because the CLO equity are also paying LIBOR plus the excess arbitrage of the structure, the excess margin of the structure. So this excess margin is in some way is suffering a bit from the first 1% hike from 0 to 0.5 or 0.75, and then it is benefiting from that. So in the US, we are already over. In the Europe, we are not yet there, but it's relatively immaterial in terms of long-term performance.
And from a credit perspective, at what level would you start to be worried about rising interest rates?
Definitely, when it's also a question of real rates, and that's very important because you see that, and I can share with you the screen relative to long-term default rates for the 70s. Inflation is clearly not the issue. The issue is when the central banks are fighting very strongly to fight against inflation. So if tomorrow and next year in the US we are still, I don't know, with 6% inflation and interest rates are at 2.5, that's absolutely not an issue. If we are at 6% inflation and interest rates are at 5, yes, it starts to be an issue, and it's clearly an issue. So the level depends a bit, obviously, on the level of inflation, because inflation is eroding the debt that companies have to pay back at some point or to refinance at some point. But I will say that, yeah, above 2.5, 3%, we start to see an impact on companies' ability to pay the debt.
So I mean, the message basically is rising rates from here, you're very, very comfortable with. The next question is, can management give an indication of the potential impact on distribution based on a range, a matrix of default and recovery rates?
I will say that typically for CLO debt, there is no impact, and CLO debt are able to resist to 4 to 5% default every year. So we are far from that. On CLO equity, and we saw that with the COVID, if at some point default reach, let's say, 4 to 5% or a bit higher than 5%, it also depends on the level of CCC loans in the CLO. So it's not only the default, it's also the CCC bucket. But basically, you need something like a shock of 5% on CCC and 4% default, and then you start to see some impact on CLO equity cash flow. So our scenario is that this year default are probably going to increase 0.5 point. So we might be slightly above 1% in Europe and slightly below 1% in the US at the end of this year. Probably next year we are going to see a higher level of default. I will say probably slightly 2%, below 2% in the US, and probably between 2 and 3% in Europe. So those levels are definitely not putting in danger the cash flow we are receiving at the equity level. But yes, after that, you need more than, let's say, 4 to 5%, with as well a shock on the CCC bucket.
So I mean, the business message is defaults need to rise significantly from where you and the market expect them to be before there is a real impact. And
to last, because if we have 1 year with 5% default and then default are back to, let's say, 2%, on the long term, it does not really change the trajectory in terms of performance.
Yeah, a couple of relatively technical questions, which I think we can probably deal with quite quickly. I assume that when you refer to default, you do not mean technical default, given most of the underlying loans are covenant light. Is that correct?
Yes, we mean typically for the US, we mean a real default with the company going into Chapter 11 and then being unable to repay either the coupon and the debt. So yeah.
Yeah, and then just another very quick technical one. If a loan is in payment default of interest and the interest payments are rescheduled, would you regard that as a default?
No, if it is just rescheduled and then the payment is made, yes, rating agency will classify that as a default, but it will have no impact on our cash flow except a slight delay in the cash flow. So. Yeah.
And there's now a more operational question, which is really in terms of the management, in terms of the trust. What hedges, if any, are in place for credit risk? What concentration risk groupings do you analyze and manage to?
So in terms of hedges, clearly our position, CLO debt and CLO equity, are leverage position from of loan pools. And so hedging this kind of credit risk will be very, very costly. So we never did it, and I don't think we will do it. So the only way we manage that is to allocate more or less, to have some cash at some point in time in the fund, but hedging the credit risk of leverage position like CLO debt tranches or CLO equity tranches is almost undoable. In terms of diversification and in terms of risk, one thing we have to remind to our investor is that a classic CLO in the US is made of between 300 and 400 different loans. In Europe, it's between 200 and 300. So when we look at the underlying loan pool that we are plugged to through Volta, we are exposed to more than 1,400 different loan issuers. So we are very, very, very diversified. So the question for us is not to have 1% default or idiosyncratic default or these kind of things. The real question is a macro bet. Are we going to see 4% default, 5% default, triple C shock coming from rating agencies? That's really the question. The matter is not idiosyncratic default from time to time.
I suspect this question you've just answered, but when we get great uncertainties such as Russian invasion of the Ukraine, how do you look through the CLO structures to assess the risk in the underlying borrowers?
We clearly look at it through industry exposure. And so typically what we did for the last 2 months is having a regular call with CLO manager and typically asking them and making sure that they are addressing properly the risk of loan downgrades, because in a classic CLO, something like between 30 and 35% of the loans are single B minus loans. And for a CLO, technically speaking, the trouble comes when you have too much triple C. So if you have a portion of those single B minus loans which are downgraded into triple C, at some point you start to have some issue. And so we are having a lot of calls with CLO manager, first telling us that we would like, and we ask them to do something to manage the downgrade risk. And so most of them are already doing that. They are arranging their portfolio, lowering the single B minus bucket in order, if tomorrow there is a bit more downgrade, to avoid a significant increase of the triple C bucket. So that's really the way we manage the risk, is through the discussion we have with CLO manager and trying to have them and making sure that they are doing the proper job of reducing the risk in the portfolio when we think that tomorrow is going to be a more troubled time.
Brilliant. I mean, it's very encouraging as a debt analyst. We've had so many questions on credit, but moving on to some other areas and focusing perhaps on the discount. How is the discount to NAV impacting Volta's ability to grow?
Oh, very strongly, as you know, Mark. We have a very strong commitment on our side, but from the board of Volta, not to issue any share at discount to NAV. So the only way for us to grow the company is to be able to issue new shares at some point at NAV. And so definitely, as long as the share price is 15 or 10% discount to NAV, we are absolutely unable to grow the company. That's why we are having this kind of call, is to market Volta and to have Volta trading close to the NAV at some point in time, and then being able to grow Volta at some point in time.
Another question is, what is the board's policy to control the discount?
We know that some of our competitors did at some point some buyback of their share. And what we observe from what they did is that obviously when at the point in time you are doing the buyback, it works. You have an impact on the gap between the NAV, the share price and the NAV. But once the buyback is over, you are back to the similar situation. And it could be very counterproductive in the way that through a buyback program, you are going to buy shares from the shareholder, which are probably the most active. And so it may happen that you end up with even less liquidity after your buyback program. So that's the reason why at Volta, with the board, the board never elected to do a buyback program because we are not convinced that it really works for the type of company we are managing. So the things that the board are doing is they employ Hardman and Hardman Co to do some marketing. We have a broker, Senkos, which is very active as well. So the idea is really to market the fund, to be active on this point. The second thing was also to decide to simplify the message. Volta at some point was a mix of CLO, ABS, regulatory capital trades. We understood at some point that probably it was a bit complex for some of our potential clients or clients. And so we decided to transform Volta. So it's going to take, again, 1 or 2 years, but to transform Volta into a pure CLO fund, debt and equity, so that it's much more easier to understand the message as an investor.
So marketing and simplifying the message. The final question in this area is, has the company considered alternative ways of raising finance, such as preferred shares?
Not. It has never been discussed with the board.
Fine. Looking at the dividend, because obviously the yield is a very attractive element of the shares, could you discuss the likely medium, i.e. 3 to 5 year growth outlook for the dividend? And secondly, you've delivered a 8.6% total return on NAV since inception. The target dividend payout is 8% of NAV. Is the yield driven by this long-term return or some other factor?
Good question. The dividend now for many years has been fixed or almost fixed by the board at 8% to the NAV, which is 9.5 or 9% to the share price. This dividend is very highly covered, so we expect to continue paying this dividend. As we are receiving more cash than the dividend rate, we may see through time an increase in the NAV. So the dividend will follow the increase in the NAV. So I think considering the current situation, it's reasonable to expect a NAV increase by between 2 and 5% a year. So that's normally the pace at which the dividend should increase.
Unsurprisingly, moving on to costs, please can you discuss the charges, ongoing costs, and in particular bonus arrangements? So it's a nice general open question for you. Can you just comment on costs?
So the costs are very, I think, very transparent. AXA IM is paid 1.5% fees as a flat fees, and then we have potential incentive fees. So to have incentive fees, we need to we capture 20% of the excess performance above 8% with a high water mark. So we are not going to benefit from any volatility if at some point there is some volatility. So it's really the way it works. And after that, there is the cost of the board and running a company like Volta with secretariat, an auditor, an accountant, and so on. So the overall cost of the admin fees are something, including the board, are something like 0.35 or 0.4%. So let's say that before incentive fees, so before we perform very well, the level of fees is slightly below 2%. The level of cost, sorry.
Few operational questions. What percentage of CLO in the pools where you have controlling interest?
That's a good question. So on CLO debt, we basically don't care of having a controlling position because CLO debt and typically double B, single B have no voting rights or almost nothing. But on equity, let's say that we have a controlling position for probably half of the equity we have in Volta in terms of mark to market. So not only through Volta, but through other programs. So we have at AXA IM, we have 4 different programs which are investing in CLO equity. And so altogether, those programs control, let's say, 50% of the CLO equity that we have in the book.
Roughly, what is the percentage of underlying loans that have a bullet principal repayment?
Almost all of them. The loans are generally a bullet.
Okay. Over the last year, roughly what percentage of new investments have you sourced through primary and what percentage through the secondary market?
I don't have exactly in mind the figure for the last 12 months, but in Volta, we generally source 70% in the primary market and 30% in the secondary market. So it really depends on the volatility. So But yeah.
And finally, on the operational side, under what circumstances would you see the percentage of CLO equity going over 65% of total assets?
Good question, because I think the right balance is probably, yes, 2/3 equity, 1/3 debt on the long-term basis. So close to where we are nowadays. We will definitely increase the CLO equity bucket if at some point there is good and strong opportunity in the secondary market. So if for whatever reason tomorrow we are able to purchase CLO equity at significant discount, yes, in this kind of situation, we will increase the equity bucket.
This is a question which is going to be impossible for you to answer modestly. Yeah, in the GFC crisis, you/AXA delivered market-beating returns. Yeah, your slide highlighted this is a great opportunity to invest. How did AXA deliver superior returns? How did you deliver those superior returns? So I think it's really a question about what are you doing differently that means you/AXA deliver market-beating returns.
No, probably one thing to mention is that Volta was launched in 2006 and 2007, and so Volta, in terms of typically CLO equity, was made of the 2006 and 2007 vintages of CLO equity, and probably it will surprise some of you, but those vintages, thanks to the great financial crisis in 2008 and 2009, those vintages are the best ever vintages for CLO equity. So they suffered default in 2008 and 2009, but they benefit fantastically from reinvestment opportunity inside the CLO. So the ability to buy loans at discount for years and years in 8, 9, 10, 11, 12, to buy new loans with spread that was basically double the level of spread in 2006 and 2007, those things lead to fantastic performance to CLO equity. And it is in some way what we saw with the COVID. Through the COVID, there has been some default, there has been some volatility, but basically CLO equity continue to pay and benefit from the fact that they were able to purchase some loans at discount. And so just to make a transition to the current situation, generally people think that when there is volatility and when spread are higher, there is no more prepayment on loans. And it's basically untrue. If I look at the worst year, which is 2009, and the worst year in terms of default, prepayment was 10%. So even in 2009, when loans were trading 70%, 10% of the loans had been prepaid at par. So it's generating fantastic opportunity for CLO manager to reinvest loans prepaid at par into loans in the secondary market at 70%. And typically, when we look at the current situation, it's almost sure that in the coming 18 months, we are going to have between 20 and 25% prepayment. So that's why we think that there is value in CLO in the primary market, because you can buy a new CLO with loans purchased at 95% or 96%, and basically 25% of those loans are going to be prepaid at par in the coming 18 months. And so it's going to generate value to the equity. So that's the way we succeed last time, and I hope we are going to succeed this time again.
And just in terms of what AXA is doing to deliver superior returns?
Oh, probably first having this kind of knowledge of the market and understanding of the situation. And the second thing is being able to seize opportunity in the secondary market. So it's true that during the great financial crisis, CLO debt was selling at so stupid low level, but we took opportunities there. I don't think it's going to repeat. I don't expect the CLO market to trade at stupid levels at it was in 2008 and 2009, because 2008 and 2009 was with many leverage on CLO, which we are not anymore in this kind of situation. But yes, at some point, typically at the moment, we have the possibility to buy a single B tranche of CLO with a projected return at 20% at the moment. So that could generate good return.
What is the total amount of CLO funds that you personally manage within Volta and outside Volta?
So as a team, my whole team, we are managing almost 21 billion of CLO debt. 80% of that are AAA, AA, single A tranches on a buy and hold model for basically for AXA Group. So it's taking some of our time in terms of sourcing, but not a lot of time in terms of management. And in terms of funds which are active, like Volta could be active, we are managing only, let's say, 4 funds or 5 funds, which are very active funds, and we are 2 portfolio managers managing those funds. So, and those 5 funds are collectively representing 1.5 billion. So Volta is basically 1/5 of those very active funds. And Volta, to be clear, Volta is for us very important because it is clearly our flagship. Volta is very well known, very well seen. So we pay a lot of attention to Volta performance. You can be sure about that.
Brilliant. Well, that was very helpful, very informative. I'll just hand back to Serge to give a wrap-up summary.
We are entering into a period of volatility with more uncertainty, probably and mostly at some point more default. But the good thing with Volta is that Volta is generating a lot of cash flow, very high cash flow. So it gives us the opportunity to seize opportunity both in the primary and secondary market. And like any other funds, when you are able to reinvest in period of stress, it may happen, and it is what we hope succeeding doing. It may happen that at the end you perform very well because and thanks to the opportunity you seized in period of volatility. So that's the message, to say that obviously this kind of period is a period of stress, is a period of questioning, but it's also a period of opportunities.
Thank you very much, Serge.
Thank you everybody for attending.